Hey everybody, back with another video, and today we're going to be looking at the CPI report that came out this morning for February inflation. We'll take a look at the rates of inflation and the expectations for them, the current trends, what's happening in the economy and the markets, particularly how the bank collapses are playing into this, what that all means for you, and what the Fed is likely going to do. Without further ado, let's get on into it. As you've probably heard and can see here, CPI rose 0.4% month over month and 6% year over year for February, which is down from January's 0.5% and 6.4% respectively. Both of these were what economists quote unquote thought was going to happen. Going to core inflation, we can see that it rose 0.5% month over month and 5.5% year over year, which was very close to what was expected, the month over month being 0.1% higher. As we can see, the general trend here in inflation is going down from the peak, but still as high as it's been in 30 years. So inflation is still raging. When people are saying inflation is going down, note that means it's going down from extremely high to just very high, if these numbers are accurate. We're still nowhere near the quote-unquote target of 2% and nowhere near the general trends of around 2 to 3% over the last 20-ish years. So just keep that in mind. Prices are still going up if you're going out to grocery stores, if you're looking at, general, pretty much any item, stuff is still going up in price. There's some small drops across the table, but these are not really due to inflationary pressures. These are things like, car prices haven't increased as ridiculously as they did, especially used car prices, just because the market got flooded. People are now strapped for cash, and with rates very high, they can't afford to take out these loans, so car inventories are starting to build up slightly. But things that are more day-to-day, food, energy, the things that get stripped out of core inflation, these things are still increasing rapidly. So know that inflation is still raging. It just isn't the, insane, probably 20 to 25% we saw back in 2022. We're probably down somewhere in the teens right now, though we're pegged at 6% according to this, if we believe what they're saying here. So what does that all mean for you? That means, your stuff is still going to be getting more expensive, just not quite as quickly. Your savings is still going to be getting eroded due to that inflation, just not quite as quickly again. When you're looking at investments and things, you really want to try to find things that are safe, things that might be pegged to inflation, things where you're either barely going to be losing money, or you can just kind of eke out that gain. For example, if you can find something safe like CDs at 5.5%, you're almost going to be keeping pace with the inflation that we have quoted here. You're going to be losing very little buying power, which in this environment isn't that bad. Whereas if you have, something that's only paying 1 or 2%, you're losing quite a bit of buying power, multiple percents year over year. When it comes to other things to invest in, the markets are still just crazy right now. As we can see, the bank collapse happened, which was mostly tied to inflationary pressures, depositors withdrawing money because they couldn't raise funds, banks holding long-term debt that went down in value, things of that nature. So know that if these bank collapses continue, we're going to see more trouble in the markets. The inflation is going to be more, it's actually going to probably take a sideline to those bank collapses in the news, even though they are connected. So just keep that in mind. What's going to happen for the Fed moving forward? Most people priced in a 0.5 point increase on the interest rates by the Fed. That's probably gone out the window now. They can't do it. There's going to be too much pressure from the markets not to do that. It would be good. It would be good if they did even more than that, but it's unlikely. A lot of people are also saying that there's not going to be any interest rate increase. I also don't see that as happening. That would be the Fed essentially surrendering, going back on their word, which they don't like to do. They like to plan to do things, even if those are awful things, and follow them through. So I would say that we're very likely going to see a 0.25%, 25 basis point increase on the interest rates, with something along the lines of, inflation is coming down. We're getting it down with our current rate of interest rate increases, and we're also taking into account the bank issues that are stuff like that. It's going to be very milquetoast, very middle of the road kind of things going forward. What does that mean for you? You're probably going to see some more slight increases in your savings accounts rates, other deposit type accounts, anywhere from, 0.1% to maybe 0.25% if you're very lucky. looking at I bonds, we're definitely going to be above zero. The apocalyptic scenario for I bond investors, we're definitely going to be above zero. I'd probably guess that I bond rates, and this is just a guess, are probably going to be somewhere between 2 and 4%. So if you are in I bonds, just know that going forward, if you're coming up for being able to redeem them, if you want to or not, if you can find better, vehicles, just keep that in mind. And that is about it. We'll see what happens next week with the Fed rate increases. That's going to give us a lot more a lot more to look at, a lot more to analyze how things are going to go over the next month until we get our next CPI report. Just know that inflation is still stubbornly high. Things are still going to keep going up in price by a lot. You're going to be feeling it in your wallet. Be very careful where you're keeping your money, not just because of bank collapses, but just because of, inflation eroding your savings. Try to find the best, safest return you can right now. As always, I'm staying out of the equity markets, but, it's up to you. And yeah, that'll about do it for this month's CPI report. Thanks as always for watching, and I will see you guys next time.